Coming up today, stocks trade mixed, the reaction to the latest iPhone, why stocks won't hit new highs anytime soon, why Tesla's rising again, a preview of the inflation report tomorrow, oil dives to 3-year lows, and how the presidential debate tonight may affect markets tomorrow. You're going to like this one, guys. Let's go. And so we had a little bit of a bounce today in the markets. S&P 500 just sitting under 5,500. Still a little mixed in market color though. Still got some weakness in small caps. Oil and energy stocks, the weakest sector out there by far, but having a little bit of a bounce back today in a few risk-on sectors. Ahead of tomorrow's big CPI inflation report. Month over month expected to come in 0.2%, year over year 2.6%, and what's really the last big economic print before the Fed meets next Wednesday, in which the bond market's already crying wolf. 2-year absolutely nosediving since the Fed last met, getting down to fresh lows again today. And stick with me because we'll take a look at that, along with crude oil a bit later on, which just made fresh yearly lows as well. I'll let you know what the implications of all that is. And so we got a little bit of a bounce back in mega cap tech today. There's the daily on NVDA, seeming to find support so far at $100 a share. However, that's still yet to be seen. I'll also let you know why Tesla's climbing again today. Bit of a bounce back in Amazon and Microsoft as well. However, just continuing on from yesterday's lead story in Apple and them unveiling their new iPhone 16, integrating Apple Intelligence for the first time. And just looking at the market's reaction today, was the softest of the mega cap tech bunch, just finishing down a touch, pretty much trading flat. Market not really sure what to make of it here. However, we've got Dan Ives from Wedbush really bullish on the stock, saying Apple will hit a $4 trillion market cap next year as the iPhone 16 sparks a big upgrade cycle. He just raised the price target on Apple, $300 a share, noting their new AI features, predicting it to make the most successful iPhone launch in history, saying there's a lot of pent-up demand and a super cycle of sales growth is anticipated, with high single-digit growth over the next 12 to 18 months. He estimates 300 million iPhones globally have not been upgraded in over 4 years, and that's true actually. I'm one of those 300 million myself, and I've put in a pre-order for my iPhone 16 Pro Max for my wife and myself, as it's been 5 years since I've upgraded, and due to a lack of really reasonable alternatives. I mean, I'd love to buy an X phone. One day in the future, would be happy to pay more, especially if it came with Starlink and I could just roam anywhere in the world. However, for now, the best choice, for me at least, is going to be the iPhone 16. So I'm going to be part of this upgrade cycle, as I'm sure many others will, even though it's been a little underwhelming for some, this latest iPhone 16. Because at the end of the day, Apple hasn't really invented any new technology itself, pretty much just using ChatGPT to integrate it into the existing iPhone. And since all these AI features will use a lot of compute power, when people on an iPhone 15 or older upgrade their operating system, they might find their phones slow down somewhat, which could be a soft force way to get them to upgrade as well. But for a company that's just been an absolute cash machine for almost 20 years now, they could have really pushed the envelope in this whole AI boom. They could be one of the leaders. However, what they've been more concerned with over the last 10 years is juicing the stock price higher by using all of their excess cash to buy back stock, which has certainly resulted in a great stock price performance this last 10 years. Investors are certainly happy. However, in the long term, they're not really as innovative as they should be, but they just have that huge leverage of being the largest device maker in the Western world. So you could pretty much think of Apple as like the digital landlord. They control everything that goes on inside their device. It's how they can take 30% from the App Store revenue, as well as having leverage over all the apps installed on the iPhone. So like I said, as soon as I can buy a really good alternative, I will, as I'm sure many others will do the same. However, for the here and now, a lot of us are going to upgrade to the latest iPhone 16. Even though, like I said, there hasn't been a great deal of innovation. Each new version is pretty much just a slightly better camera, slightly better screen, with a couple of other little widgets in the operating system. And this time they've just really integrated the latest AI capabilities of being able to talk to a chatbot into the operating system as well, with again, slightly better camera, screen, battery, all that. And that's why we're getting plenty of memes like this online, where this lucky guy here received a birthday present, same shirt he was already wearing. People liking that to the iPhone 15 and the new iPhone 16. So we'll keep an eye on how Apple shares perform the rest of the week. Certainly an important stock like NVIDIA. However, just looking across the market to what else is going on, we've got Ally Financial plunging 19% after their CFO says its borrowers are struggling. Once again, we're getting some companies in their management telling us they've seen some weakness in their consumers, especially the low middle income consumers pulling back, still noting high structural inflation, high interest rates, and now a shaky jobs market, impacting some the ability to repay their loans. And Ally's a major auto lender, and they're anticipating rising delinquency rates, and they're planning to increase their reserves to cover some potential credit losses. And there's a look at the daily price chart on Ally Financial. Had been a popular stock amongst investors, given they're an online digital bank. However, absolutely clobbered today, down 17% on huge volume. And stick with me because I'll let you know why a lot of financials came off today as well, including something we heard from JP Morgan. But we got some research out of Wells Fargo that says stocks won't hit new highs anytime soon, and 3 things mean the market is fairly valued. So there's a handful of headwinds that will keep a lid on further gains, pointing to concerns surrounding potential recession, AI, and geopolitical uncertainty. So they're saying we may have already seen the high for this year and potentially this whole cycle, which was 56.70. They're citing that the AI trade has pulled back and the defensive rotation shows that big institutions are already preparing for an imminent recession, deeper pullback in the economy, and that given that stock market valuations are already at very lofty levels, they're arguing there's more room to fall than for them to keep on rallying. And it's true, they do have a point. There is signs of weakening out there in the US economy, with the biggest key risk being the jobs market. Consumer spending is still somewhat keeping up with inflation, so real spending's not really growing. We do have softness in manufacturing, although services PMIs are still in expanding territory above 50. And just after, like we heard from Ali Financial, we're hearing a spate of companies now coming out and pointing to weakness in their customers, and they see more just around the corner. And this always had to happen at some point. Can't have record inflation, interest rates at restrictive levels forever without it eventually biting, not at least the bottom 50% of income earners. And what's really hurting a lot of consumers, and again, this is a trend not only in the States, but largely around the West. Over the last 20 years, been a huge increase in health insurance premiums. In fact, they're up 314%. And even with the big inflation we've had these last 3.5 years, that's still absolutely trouncing it, with inflation up 83% in that time. And while that's been a boon for the US's largest health insurer, United Health Group, that same period, the stock up over 11,000% versus, again, the S&P 500, which has done well in that time, 479%. So the shareholders in these health insurance companies are doing very, very well. However, a lot of people are struggling to pay those premiums and buy food as well. And so there's real weakness in the economy. And as more and more consumers feel their discretionary spending get pulled back, that has to show up in corporate earnings per share, in a lot of cyclical companies at least. And so the stock market had been holding up pretty well up until a bit over a month ago. Then we just recently had a retest a week and a half ago, pushing up to all-time highs before there's a little bit of a rug pull. Just looking in the past at the price action of the S&P 500 going into a recession here in the dotted vertical black line. Quite often the stock market can rally up until about 6 months prior to the recession. Then it'll kind of choke up, go sideways. Then once the recession starts, down she goes. And you can see the dispersion of returns. Inside of a recession, 9 months in, are quite wide, up 15%, down 35%. But interesting to note going into it, the market kind of just chokes up sideways, not a whole lot of dispersion either. And so is that the pattern we're currently in right now? The market has definitely been choking up for a few months. Are we about to go into this consolidation period for a few more months? And maybe in Q1 next year, the economy takes a nosedive on spiking unemployment. Since it's after the federal election, maybe the Feds, Treasury, and a lot of other key agencies may not be as willing to support the market if we were to get a change of government. One thing that is different about this year is the outperformance of utilities. In fact, the best performing sector, which is typically a sign of a massive defensive rotation in the market, since cash flows in utilities are much more stable, not really cyclical. Everybody still has to keep their lights on. And we saw that in 1977, utilities held up, the market came off a bit. A massive outperformance in the year 2000, when the S&P 500 was down. Utilities were up 51%, again in 2011. However, what's different this time is we've got utilities positive, and if we were to finish the year just like this, S&P is positive as well. However, like I always say, each time there's different nuances, history rhymes, doesn't always repeat, because what's different about this time is the AI boom, the huge increase in demand for electricity, and that's forecast to continue. And that may be why we've got both the S&P 500 outperforming with those big AI stocks, leading the charge, and utilities doing even better as well. And like I said, utilities is a good sector that can kind of win either way. If this AI boom continues, they can be a massive beneficiary, or if we go into the recession, they could continue to hold up. Given their defensive nature, they may just lose a little bit of that AI premium valuation. But even with the weakening economy, there's still no shortage of NVDA bull out there. In fact, most of Wall Street and analysts still really bullish the stock. We've got Dan Niles, a fund manager, believes NVIDIA stock has much more room to grow, and he thinks shares could double in the next few years. On the back of heavy spending in AI, calling this latest consolidation in the stock price a short-term digestion phase, and he believes a tech surge can last longer than most people anticipate. Wall Street analysts have an average price target $153 a share, implying another 44% upside from its current level. Had a bit of volatility in Tesla of late, started performing better than mega cap tech, then had a big fall to start the week, Now it's just bounced back again on the back of a new buy rating from Deutsche Bank, calling the stock in a league of its own, saying Tesla isn't just an automaker, but rather a technology platform attempting to reshape multiple industries, deserving of a unique type of valuation framework. Pointing towards their AI, self-driving and robotic businesses as being key catalysts. We got the Tesla Robotaxi event scheduled for October 10. It was initially penned in for August. They pushed that back. That'll be a key event to try and impress investors and help them retain their lofty valuation, as they're still well and truly not valued like the rest of the auto industry. And the market could be warming up to it again, hopping back above its 50-day today, up 4.5% on pretty good volume, but just zooming out, we're still not back to where we started the year, up around $2.50 a share. Deutsche Bank have got a price target, $2.95 a share. And like I said, a month from now, they'll be unveiling their robo-taxi for us all to take a look at. Not as bearish as Wells Fargo today was Goldman Sachs, saying no bear market for stocks in sight, even as macro and policy uncertainty threaten further volatility. So they acknowledge those risks, but despite all of that, they still see low odds for a bear market due to a strong private sector and expected rate cut. So they're saying it's pretty low chance that the market's going to drop by 20%. In other words, they're betting on a continued soft landing in the economy. They don't think the unemployment rate's going to spike, and GDP growth and corporate earnings per share can hold up. And we are in a seasonally bullish year, the election year. Just looking back in history, we most often see a peak in the VIX in the month of October, 63% of the time. Remember, we had that VIX at 65 on the 5th of August. Very good chance we could be in this 25% category this year, because for it to make a new peak in October, we'd have to see the VIX at 70 or above, which would mean an even bigger day than what we had on the 5th of August. And interesting, just looking at the stock market's performance, the last two elections we had, in the green line was 2020, and in the purple was 2016. What's similar about those two past years and where we are now in the white, the market was kind of consolidating, bunching up a little bit going into the election, then once we got out of the election, market just ripped up for months afterwards. Here's another interesting visual for you today, titled Bear Markets and Corrections Have Been Less Frequent Since the 1990s. Occurrence of the S&P 500 drawdowns within a 12-month window. In the light blue, 5% drawdown, the dark blue, 10% drawdown, and in the orange, a 20% drawdown. So you can see in the 1930s, going into the 1940s, market was just full of drawdowns pretty much all the time. Then that thinned out in the 50s, got a bit more volatility there in the 70s. That was 1987. Then a little bit at the start of the century in the early 2000s. There's the GFC, but it's pretty much been smooth sailing ever since. COVID doesn't even really show up. It was so short-lived. And so it's been a good 30 years since we've had a regular occurrence of sizable drawdowns in the market. And so as the market really changed, the Fed put, which came in 1987, quantitative easing, which really came in 2008 and 9, pretty much everyone's pension fund buying stocks every week and month since the 1980s, people being able to buy US stocks from around the world straight from their smartphone, occurring in the last 10 years. Have all these things structurally changed the market, or are we just in the midst of a big cycle? Low volatility, that's eventually going to go back to a couple of decades of high volatility. We've also got Deutsche Bank offering 4 positives to focus on as recession fears grip the market. The firm says the narrowness of the stock sell-off is one reason to not overreact. Also pointing that job growth remains stable, stock market's decline has been narrow, rate cuts are on the horizon, and that recession indicators are not what they were. Arguing that the post-COVID economy is behaving differently somehow. For example, perhaps consumers were cushioned by the pool of excess savings built up in the pandemic. And it's true, that is a big key difference. COVID was probably the biggest economic event of our lifetimes. Not only shutting down the economy for a few months, but more importantly, the complete and utter overreaction and overcompensation from both the federal government and the Federal Reserve, absolutely flooding the economy and markets with fresh liquidity, kind of lifting up this massive rug and shaking it, which inflated the price of pretty much everything, for mostly the benefit of those up the top at the expense of everyone below it. And that has kind of distorted a lot of economic indicators and data. And like I said, there's just different nuances every and each time, and that's why nobody knows for sure how all this is going to play out. And we actually had JP Morgan Chase president pouring cold water on markets today as he advised investors to lower their expectations for net interest income next year, as analysts had forecast that to be $90 billion, but Pinto said this is too high as lower interest rates reduce the pressure on deposit repricing impacting net interest income. And the market didn't like that one little bit. Massive bearish engulfing candle here. JP Morgan, the biggest bank in America, finishing down over 5% today on huge volume. We also saw Goldman Sachs close off by more than 4%. However, a stock I haven't mentioned for a while, what I call the BlackRock Barometer, largest asset manager in the world. Good idea to look at for the health of the stock market. If they're doing well, that means their assets under management are doing well. And just looking at how they've traded this year, they're up about 10% and still holding above the 50-day VWAP as I speak now. So the stock market can't be doing that bad if this stock is still uptrending. But it'll be interesting to see how the market reacts tomorrow. Whatever CPI inflation print we do get, I expect it to come in line, showing a month-over-month increase 0.2%, year-over-year 2.6%. That's the headline expectations. And I'd say if that's what we get, Jay Powell will probably go ahead with a 25 basis point cut. If it comes in a lot cooler, in other words, prices are diving, that along with the weakness in the jobs market could potentially justify a 50 basis point cut. However, at this stage, I still pretty much agree with the market. I think it's a 70-30% split in probabilities as to what size cut we get next Wednesday. And so Jay could start off big. He may be seeing some data we haven't seen yet that shows the jobs market is deteriorating fast, and he may come out and justify a 50 basis point cut with that. However, he may want to walk the line a bit and not reignite animal spirits and get inflation going again, and just want to start off with 25 basis points and once again stay data dependent. But at this stage, it's still up in the air. Just looking at the price action and bond yields, like I said, it's almost like they're telling the Fed to do a 50 basis point cut. Certainly really weak here. You could say almost already pricing in a recession, given where the 2 year's at. And the oil market may be doing the same. Got really soft bond yields and really soft oil. It's kind of implying softening demand around the corner inside the economy. Got the price of crude oil falling to the lowest in years. OPEC cutting its oil demand outlook and delayed production boosts whilst US production hits record highs. And like I said, this has been absolutely fantastic timing for both the Federal Reserve and the federal government. Oil hitting lows. Going into rate cuts, going into a federal election. Compliments to the chef for the timing on this. But that's been helped out by a weak picture in China. Their economy a little bit in shambles over there. Still trying to put a floor in things. Really low consumer confidence. Consumer discretionary spending. Building, construction, all of that stuff. Property stocks still getting whacked, and that too is weighing down on crude oil, which just fresh took out my support box sitting at $68 a barrel. Now it's down on a 66 handle, and I have to actually go out to a weekly chart to see where we are here on oil. I think we can move this support box down to around the mid 60s here, around $65 a barrel, right where it's already trading, and we'll see if that's another area crude oil market can find support. Otherwise, this is great news for inflation, great news for consumers, and it just helps to add to the cyclicality of economies and markets, because when oil gets too expensive, like it did in 2022, that affects demand. That can cause weakness in the economy and the market. Then when oil gets really cheap again, it's kind of like interest rates. It can stimulate demand, make things cheap to build, and get the economy moving again. But just like the bond market, it doesn't see a whole lot of demand or inflation just around the corner. Just moving on, we had earnings out from Oracle yesterday, beating expectations, giving a real upbeat guidance and outlook. They expect to build a lot more data centers to help the AI boom, and the market loved it. That's a new all-time high for the stock, $429 billion in market cap. Also interesting to hear the founder and chairman, Larry Ellison, said he sees a $100 billion AI boom powered by nuclear energy. He believes this AI infrastructure boom will last for years, saying if your horizon is the next 5 years, maybe even the next 10 years, I wouldn't worry about it. The business is just growing larger and larger and larger. There is no slowdown or shift coming. Said Oracle has 64 data centers, and he can see that number going up to 1,000. And he said, the entry price for anyone who wants to be a real player in AI is around $100 billion. And as a uranium bull, it's good to see one of the world's richest men forecast that the AI boom will be powered by nuclear energy. And it's looking at the price of uranium. Like a lot of commodities, it's pulled back the last couple of months and currently being tested down the bottom of its support zone as well. We have had some signs of accumulation here, so I'll be keeping an eye whether this level can hold. And so we're just about to get the first presidential debate between Harris and Trump, which starts a little after this video is published. And last time we got a pretty big effect in the markets after we heard Trump and Biden have a debate. And so there's going to be some key issues that have been discussed that Americans and a lot of people around the world actually want to hear what their stances on a few things like taxes, big one, immigration, and tariffs. Investors small and large will be watching, as will institutional capital, to help decide their positioning. Key markets are small caps, Bitcoin, financials, with one analyst saying that the market seems to still favor a Trump victory, so anything that would move the needle in that direction during the debate would statistically suggest that the market would move higher on that news. So basically saying whoever wins the debate, in which that's unofficially declared just through perception, again depending on who you ask, could play out in how markets trade tomorrow. Also interesting to hear from Harris today. When she's president, she will take on corporate landlords that unfairly raise rents on working families. And I can see how that sounds appealing to a lot of people, just like what she said about food as well. Kind of implying food controls, rent controls, which again sounds good on paper. However, if you study history, there have been a few countries that have tried this. One of them being Argentina, in which the economy went backwards for decades, suffocating under high inflation. Amongst other things, one of the first things Javier Milei did when he took over at the start of the year was he got rid of rent control in Argentina. As a result, housing supply skyrocketed because it frees up real estate developers to build more when there's the incentive of profit. Once again, it's not your local grocery store or your local landlord that is responsible for high prices, even though I'm sure there's localized and one-off instances of the like. It's more to do on a structural level and how much currency is floating around out there in the country that causes inflation. That affects those at the bottom. And again, you just need to study history to see what the effects are of trying to exert price controls inside your economy when the state becomes more bigger and wants to meddle inside the country's companies and telling them what they can charge. But like I said, after Milei got rid of it, rents have plummeted in Argentina this year and he's turning the economy around. Another key issue a lot of Americans will be wanting to hear about is what a potential new president is going to do with immigration, both legal and illegal. And this affects the economy and the markets. Because just like we heard from Janet Yellen at the start of 2022, she said the White House was aiming to increase labor supply, which they certainly did with a record amount of illegal crossings. And now we're getting some reports some of those illegals are stealing people's cats only to cook and eat them. There is some unfortunate footage being circulating on social media. I won't show, however, I thought I'd show the funny stuff. Cats in Ohio right now, and other memes like this being thrown around on social media today, which are funny, but I can imagine it's not really funny for someone if they've just had their cat stolen. So either way, it'll be interesting to hear both candidates' stance on this whole issue. And one market that may just give us a clue on how big investors are thinking on who won the debate could be Bitcoin, as the crypto industry would prefer a Trump win when it comes to the federal election. Another key indicator I'll be looking at is the spread between small caps and large caps. Ever since Biden pulled out and Harris took over and her popularity shot up in the polls, so did the spread of small caps and large caps start pulling back. As once again, small caps are more domestic American companies, more of their production onshore, more of their sales onshore versus the S&P 500, which is more global in nature, with one side said to be more in favor of nationalism and the other side more in favor of globalism. But really the big one tomorrow, first up in the morning, is inflation data. Like I said, year over year 2.6% expectations with core at 3.2. May get a muted response from markets if that comes in line as expected. However, if we get any surprises, that's going to really change the pricing in key markets out there. But at this stage, option dealers are pricing in a little bit of movement. VIX 1 day at 19.18, just a little bit below the VIX 9 day, with both actually above the VIX 30 day. A little bit of backwardation up the front. So option dealers potentially pricing in a bit of movement for tomorrow, up or down, and we can see they're still asking 4.3 points above realized in premium to sell option contract. I'll also be watching the dollar as well, which has just put in a pretty good bullish divergence on volume, trying to find support here around 101, after it too's been really weak since mid-July. Got to keep an eye on the dollar yen as well, which is currently sitting at those lows from the 5th of August. The Fed does cut 50 basis points. We could get another yen carry trade blow up 2.0, tighten the spread between US and Japanese interest rates. There's a look at gold sitting above $2,500 an ounce, and the bond yield curve still back to uninverted territory. Otherwise, that's a wrap for today, guys. Like I said, market a little mixed here. Just waiting for the CPI report, and we'll see what sort of reactions we get in markets tomorrow. Thanks very much for sticking with Click Capital, and I'll see you again tomorrow night. Cheers.